Hi everyone, good evening and happy Friday. And Fridays are always fun for me because the happy mood starts. And we welcome you all to the another interesting session of our SLP Leadership Speaker Series. Today we have two sessions for 30 minutes each. One will be, of course, led by none other than our dear Nikita. And one session will be by Bhavesh Sanghvi, who will be joining later around 9 o'clock. And we'll try to keep a tab on time so that sessions can progress well. So keep your questions for the end. And you can even post it on chat if required. So without further ado, let's get started. And I will welcome today's speaker, Nikita Vyas. She's a trailblazer in HR, administration, and IT with over 16 years of experience, including roles at Mastercard and Gujarat Guardian. Nikita's leadership has spearheaded remarkable growth and success. Her dedication to diversity, inclusion, and equality has left an indelible mark on every organization she has worked with so far. She is a proud alumna of IIM Ahmedabad. And Nikita's academic prowess is matched only by her real world achievements. From textiles to IT, you can imagine the plethora of work she would have done. Her impact knows no bounds. As we gather tonight, all of us, let us embrace Nikita's wisdom and celebrate her unwavering commitment to excellence. Welcome, Nikita, a true visionary in every sense of the word. We really look forward to listening from you. So, over to you. Let's get started.
Hi everyone, and especially Sumita, the way you explain me, I'm already feeling under pressure that I have to really come to that expectation, right? But I'm really glad that we have this call, and Ankit, Varun, Preeti, you, Ritika, you guys have thought of me doing the justice of coming and sharing knowledge. I'm really glad. And at the same time, let me also say, someone who has actually imbibed this thought in me is none other than Mr. Bala. I think I will like to call Bala here. And let's see, Bala. Yeah. Okay. Bala, thanks for joining on video. I think what I'm going to enjoy is that I'm going to share knowledge, but at the same time, this faces I'm seeing, happy faces I'm seeing after IMA. So let me cherish this for a 1 minute, and I'm sure I'll just look at the watch. I'm going to do the justice within the time, and I'll be also try to see that if we can save 5 minutes more so that I can also take question answer, right? But before I really start, Raut ji, I'm going to really look at you when I feel under pressure, okay? And we have one more member, which I can see on video. And if I really feel like, stopping little bit, get relaxed, I'm sure I can look at you. I also see Rahul on the call, right? And I think you both are going to really help me with that. But before that, let's just start the session because I think we all are here to share knowledge, exchange our thoughts. And let me just start sharing the screen. What today I'm going to share with all of you, you might heard it before. If no, I will be happy to share. If you already know it, then also in that case, I'm sure that you will try to learn something more out of it. But let me just confirm one. Sumita, can you see the screen? If you can confirm.
Yes, we can see the screen.
Okay, perfect. So then let's start. What I'm going to talk today, or the topic for today's session, is principle-based management. Now, as you all know, I'm working with Gujarat Guardian Limited. This is a joint venture company between Guardian Industries US and Modi Rubber Limited India. We do also have a 10% stake of Gujarat state government in our organization. Basically, we our company's name Gujarat Guardian Limited. We are a joint venture, and this company's parent company is a Coke company because Guardian has acquired by Coke, right? So this is pretty much small brief about the company. Why I essentially introduce the company, because the methodology today I'm going to talk is derived from our parent company, which is a Coke company here, and which is by the visionary, uh, person who owns this, I would say, is none other than Mr. Charles Coke, and this is deriving from the principles, and I would like to talk about that today. Now, just first, I would say early impression. Why I choose this topic to talk? Let me say that this is something I found in my 16 years of experience, that principle based management is a framework which is none other than our core values. Okay. And if we really make this as our base or foundation, I would say that it makes our life easy, our work easy, and whatever we do, be it, whichever capability or department you are in, your work really really easy by applying this principle based management. Okay. At our organization, we apply principle based management in each and everything we do. Now, sometimes I get this question really from, let's say new hire employees I have in organization, and they will say that, every organization has culture, right? And so as your organization has culture, why you really will, pay attention so much, right? And why you will say that it is so special. I'll try to give answer to that by saying that, every company hire and pay people, they design different roles, they take a lot of new projects, they have different approach, right? But what we rely here in this principle based management is to take any decision, we rely on the principles. Now let me a little bit simplify it, because I think I'm so far talking about principles, but I should also try to make it little bit in a layman language. Let me simplify it. So we recognize that each of us are unique, we are special, right? Now some of the companies, what they do is that they put the job first, job description first. They decide that this is the experience we are looking in someone who's we are going to hire. This is the technical knowledge we require. This is the education we require. And then we are going to hire basis on that. Versus what we do is that we first see that what is the unique collection of aptitude, skills, interest, and characteristics the individual is bringing to the organization. And then according to that, we design the role. Now, by just going by what I'm saying, it looks also a little too much at times, and we feel that how is it really possible, right? But in principle based management, really it is possible, and we call it as the comparative advantage of an individual. And I think some of us have heard this term a lot in IMA, if I'm not wrong. Reason is that comparative advantage is nothing but individual's interest and also the gift the individual is carrying to any organization he or she goes in. So let me move to the next slide and talk more about it. But I would like to again call out that the success we have in our core companies and the employees carry with them is by applying these principles, which we call it as principles of human progress. I'm moving to the next slide, which is talking about the dimensions. Now, as I promised, the topic of the discussion today is about critical dimensions and principles. Uh, why dimensions and why only 5 dimension I'm mentioning here? So I will say that this is what the base, again, we are deriving, which is the 5 dimension. And I'll explain one another each. I would like to keep it brief, but what we will do is towards the end when we will have question answer. If there are more questions around any of the dimensions, I'll touch upon that. These are the 5 dimension. If we name, then it is vision, virtue and talent, knowledge, comparative advantage, and motivation. And any activity we do, any new project we take, any decision making framework we are doing, what we do is that we apply this 5 dimensions. Now, in your role, in your business, how you can do that, let me try to explain that each in detail. I'm just moving on to the next slide, which is going to talk about vision dimension. Okay, this is going to be now interesting. Please pay attention, everyone, and also keep your questions ready, because I'm sure that when you will hear more, you are going to have questions. Okay, so the fundamental difference in, let's say, we hire the people and put them directly on the job, which is, pretty much someone else was doing, versus we think about the vision of the organization first, right? And we really make each of the employee understand that what exactly we are looking out of, this organization's growth, right? What is the vision of the organization, and how are you going to create the value? I feel that individual will connect to organizations. Finally, what is the outcome organization is expecting? I think individual will connect it better by developing a shared vision. And how we develop the shared vision is uh, the different department capabilities, stakeholders come together, and they actually design the vision of the organization. Whereas what they are looking at is that what is the gap of current business, how is the market revolving around, and then what is possible way that we can improve our company's performance from today and take it to the next level. So this is how we decide the company's vision. What we do while we are doing is that we would like to constantly see that if there are any activities which we are doing which is not adding any value, right, then stop those activities or modify it to that extent that it become the profitable activity for the organization. And also continuously see if we are lacking of any capability. When we call it capability, it can be also individual capability as well as also the department we are talking here. And we constantly would like to see if there is any capability which is then really required to change. Now, someone can also call it that this is like every organization has a vision, mission, and objective, right? And why, how it is different. I'll call it that this is not a top-down approach, okay? Whereas you have already the vision of the organization in front of you, you go to any organization and this is what you have to achieve, right? Whereas here, the stakeholders, the employees coming together and they are looking at all the possible gaps, opportunities, and then they are deciding the vision of the organization. So this is what the fundamental difference we are talking here. Now, what we do really out of what we get out of it really. Now, I feel that the vision dimension help us in connecting our team's vision or our individual vision to organization's vision, right? What we do is that we try to maximize our contribution and we see that how we can achieve this vision which is captured by us only, right? It is not coming by senior most person in the organization who is trying to tell you that okay, do this, don't do this, right, take left, go right. I mean, this is not what we are. This is what we exactly coming together and saying that this is the possible best result we can achieve. What we do is also we prioritize the good decisions and the bad decisions. We are trying to also see that if there are any unprofitable activities, we try to stop that and continuously look for the transformative ways so that it is mutually beneficial not for employees or the shareholders or the owner of the company, but also to the supplier, to the client, to the customers. And we call it as virtual cycle of mutual benefit. I hope so far, I mean, we are going fine and uh, we understand the business vision. Thanks, Ankit. If so, I would like to move to the next dimension, which is called virtue and talent. And while look at virtue and talent, I think this will be easy to understand, I'm sure, because I think talent part is something, be it you are in HR or not you are in HR, I think every one of us understand. Because after all, we all are supervisors, managers, and in our roles, we do some of the part of the HR, right? Now, what this virtue and talent dimension is. Virtue and talent are the two verticals, I will say. When we say talent, talent is none other than your skill set, your talent in terms of your technical knowledge, what sort of technicalities you can bring into the subject, what sort of experience you have. And virtue is none other than your soft side of it, which is where what sort of virtues you are, having in your individual capability, right? We used to follow the virtue and talent metric, whereas we feel that someone with a high virtues and a high talent, we would like to have those employees working with us, and also we keep them retaining in the organization. If we feel that someone is very high on talent, okay, person is really good, very good experience, doing all the great performance, right, but not able to meet the virtue which is like being respectful, providing humility to people, working with integrity, keeping all the ethics in mind, right? If there is any gap we see, we feel that that individual we would not like to retain in the organization even though the person is a star performer. And why? We know the reason also, that if your fundamentals, your core values, and your principles are clear, you are going to achieve the results definitely. But if there is a gap in you understanding the core values, right? and then there is a problem. I'll give some small example, and I think we all will relate to it. I always share it with my new joiners, I would say group of people, for them to easy to understand. So when a kid born, right, and let's say parents generally, I mean, will always think that my kid should become, let's say, a doctor or an engineer, or I mean, he or she should do something good in so and so field, right? None of the parent really is going to think really that my kid should become, a negative sort of person. I don't want to, I generally use some word, but I'm not using it here, considering the audience. I do not want to call it as a thief or so, but none of the parents are going to really think, right, that my kid should become that. I doubt. Okay. And that's what we call it as your core values. Now, virtues are none other than your thick core values, right? Which is being integrity. Even if someone is not looking at you, you should have courage to always do right thing. That's what we call it as integrity. And that's what I will call it as the virtues, right? One of the virtue of the, I would say, talent we have in the organization. Now, essentially, if I come back, I will say that we expect all our people, we expect all our employees to work within the virtue and talent metrics, whereas they should do great with respect to the talent, and they should do great with respect to virtue. If you are little bit struggling with respect to, let's say, the technical knowledge, right? If you are not getting something, if you do not understand something, it is absolutely okay to come say that I don't understand, I want more time, I'm not able to perform. We are there to help. But if there is any question regarding the virtues, whereas if you are not being respectful to others, right, I think there is a gap. We can coach you as in warning, but if it is something related to, let's say, integrity, that is not coachable. I feel that in principle based management, what we feel is that your core values are not good, then you are not going to actually learn it, right? There is a less possibility that you are going to, adapt that changes, right? Wherever we see potential, that person can adopt the good values. I mean, we try and put efforts. Otherwise, we have to also take a harsh step, right? But coming back to the virtue and talent dimension, how it helps really, because it centers our culture and capabilities by doing what? Hiring and retaining a contribution motivated people. Now, this is again a term I'm using, and let me just quickly go to the next slide, which is talking about the contribution motivated. Now, what is contribution motivated? We all should first understand, and that's where I think you will be able to connect back to the virtue and talent. So, we say that contribution motivated employee is one who is then seeking to discover, develop, and utilize their abilities to the fullest of organization's success. And as an example, let's say you have two people, and in those two people, one is trying to be very open for any challenge process comes to that individual. Challenge process is, as in, let's say, me, Sumita, and Ankit, we are working together. Ankit is the supervisor for me and Sumita. Ankit see that whenever Nikita and Sumita are having any issues related to performance, he is providing the feedback to both of us, right? Sumita is taking the feedback positively. She is trying to work on it. Whereas I think that no, it is not my problem. Actually, it is because of so and so reason that actually this work is not happening. And that is where Ankit is trying to provide me feedback. I don't think so. I have anything to do with that. And I think it is not Nikita's problem. It is someone else's problem. Or it is maybe systems problem. It is processes problem, right? We see clearly two sort of behaviors coming out of Sumita and Nikita, and I will call it as that Sumita's behavior are more aligned to contribution motivated behaviors, whereas Nikita's behavior are more, we call it as deficiency motivated. Whereas I'm not open enough to learn the things, right? So this is how we differentiate between the contribution motivated employee and not so contribution motivated employee, who are not believing that, some or other reason they are not I would say conforming to the values of the values and principles of this methodology. I'll just quickly take you back what I was, and by the way, on contribution motivated, if there is any question, I'll be happy to answer it towards the end. And I think I have plenty of examples I can share, like how I have shared one. So feel free to, hold on your questions and we can take that towards the end. So coming back, what we expect is that second dimension, whereas then the virtues and talents should be intact with any of the individual who is then there in the organization. And after vision, what you really expect is that you have right people in the right role at your organization to perform any of the activities. Moving on to, I would like to introduce you one more concept here, which is I used in the beginning, whereas I said top down, right? And let me say that mm, many of the organizations have unintentional but top down approach, right? And how it is different. So I'll say that a top down approach, whereas mostly the things are coming from top, right? And then you are performing those activities, you are taking decisions accordingly. And that is none other than but someone who is, I think we heard this hippo I think effect. We were also learning it in our IMA days, right? So someone who is senior in hierarchy, trying to be in control, taking all the decisions, and trying to typically, fit that one size to all. What happens typically here is that without understanding really that what is working best for all the talent, without really understanding that, what are, person in the top do not understand the market, do not understand the dimensions, right? But at the same time, if some one person is trying to do that versus a lot of people coming together and then trying to think, right? And then they bring the solutions and alternatives to the organization, and that's how organization looking at various alternatives decide the, I would say, one of the decision. There is a beauty in it because each of the individual can bring a lot of alternatives, and we call it as bottoms up approach, whereas all these individuals trying to bring a lot of alternatives. And on those alternatives, by the way, we are also trying to see what sort of creativity, initiatives, talent which they are bringing in, and then trying to see that what how we can reach to the beneficial outcomes which is for the organization, right? So this was one of the example in the virtues and talent part of it. I'm just quickly trying to check the timing. So the third dimension is knowledge. By the way, knowledge is nothing but again providing an environment whereas everyone of the employee trying to seek the knowledge from different alternatives they get. We also call it as always applying economic thinking. Whereas it is not only responsibility of the CEO or the department head of the organization to then decide that what is cost effective way and what is not. Okay, it is every one of us who have to then think that what is working best option for organization, right? Knowledge has multiple I would say principles, but we are looking at time and I will just share one of the thing is challenge. And while you apply the knowledge, you also would like to challenge that, because when you challenge, I think you don't challenge the person, but you really challenge is the idea, right? And while you challenge the idea, you get better alternatives. I'll keep it simple like that. I'm sure that while we look at the examples as in positive and negative, we do understand that we get those examples of what is positive challenge and what is negative challenge we can provide, right? If someone is trying to give you feedback and you are not working on it, we know that it is called a negative challenge, right? Second last dimension is about comparative advantage. I little bit speak about it, so I do not want to again go that, but I will say that looking at the talent, gift, and skill set, also what individual is bringing to the organization. If according to that, if we design the role, I would say that organization get best out of it. This is what is the this dimension. And last dimension is about motivation, whereas it can be in terms of financial and non-financial. Financial, we all know that this is none other than compensation, but wherever it is non-financial, it can be many more things which comes under the non-financial motivation. Whereas if you are providing all the freedom and conducive environment for the employee to work upon, I think that itself is a motivation where you are not doing super micromanagement of your people, right? And you are giving them all the freedom to take decisions, apply various alternative. That is none other than one of the dimension of, I would say, motivation. So this is how the five dimension are quickly, if I recap, that it is vision of the organization. When you have the right vision, do you have the right virtues and talent? Do you have the right talent in the organization? While you have right talent in the organization, do those talent have right knowledge? How they are seeking the knowledge, right? They are continuously trying to transform. Are they thinking like an employee or an entrepreneur? Fourth thing is about none other than the comparative advantage. Are they best utilizing their comparative advantage and applying in the work they are doing, from tiny to big, any activity they do? And last is that are they feeling enough motivated to do that on a continuous basis? And do we have the right mechanism to motivate them? Um, in a nutshell, if you ask about the principles to support this dimension, there are many. And I'm just presenting few on the screen. I talk about bottoms up, tops up, contribution motivated. There are many more. And I mean, principle based management, by the way, itself is a big management framework. And I cannot really justify it to talk about it in half an hour. So I'll just leave it here. And I will say that if anyone of us interested to know more about it, then I'll be very happy to connect. Thank you, everyone, for patiently hearing me. Let me know if any questions also offline, because I'll be very happy to also receive the feedback that, we understood this concept well or not, and we can connect. But thank you, Sumita and Ankit, for providing this opportunity.
Ankita, I
Over to
think you have already triggered the thought process. We do have a lot of questions and we can have some sessions maybe followed up or offline. But yes, it was quite interesting and I have made a lot of notes I was writing down, and I think it will be a good idea to connect and have a follow-up session. But thank you so much for sharing the insight. And it's indeed a quite deep process and deep understanding which is required to follow these principles and which cannot be covered. I agree with you in half an hour, but you at least gave us the trailer so we know what exactly is there. Thank you so much. It was wonderful. Okay, so let's get started with our next session. Welcome, Mr. Bhavesh Sanghvi, and I think it's with great pleasure and admiration that I introduce you, Mr. Bhavesh Sanghvi, the visionary CEO of Growthfiniti Wealth Pvt Ltd. So, if we talk about him, in November 2022, after a distinguished career in senior leadership roles within the financial service industry, I have read about you, Mr. Sanghvi, so I could see that you had taken a sabbatical and you embarked on a new journey, bootstrapping Growthfiniti Wealth Pvt Ltd into existence, and it's not easy. When I was reading about you, I saw that after almost 33 years of experience, you wanted to start something new, if I understood correctly, which is remarkable. And I would say with an illustrious career spanning over 34 years, you have brought to the table a wealth of experience and a deep understanding of financial markets. Your core competencies in strategic leadership, business strategy, turnaround expertise have earned you a lot of reputation as a true industry titan. And I could go on and on about it when I was reading through your LinkedIn profile and other areas. You are a proud alumnus of Columbia Business School and NMIMS. Your exemplary leadership has been recognized with the prestigious Chairman Award from Shri Kumar Mangalam Birla for exceptional contribution to business success, which is a testament to your unparalleled dedication and commitment to excellence. Driven by a mission to create value and impact for clients, partners, and society at large, you are not just a leader, but a beacon of inspiration for all those around you. Join me in welcoming Mr. Bhavesh Sanghvi, a true champion of wealth creation and prosperity. And we're all ears to listen to you and understand how you do all this.
Okay, so
Over
I
to
think
you.
these are pretty much kind words. I hope everybody can hear me, right? Yeah, great.
Very well.
These are kind words, and I don't think I would have probably even achieved 5% or 10% of what some of you guys would have achieved. But I
Very
think,
humble.
like one says, we're all in a journey, right? Someday this journey is going to end. However, I briefly just start by giving a brief introduction. So I come from a very humble family. So my dad used to work with LIC, and I realized very early on that that there was no money at home. So I started working at the age of 16. I initially worked with HDFC Limited I did a lot of acting actually in college. So if anybody is familiar with Mumbai and Mithibai College, then most of the star kids or the kids or actors are from Mithibai, right? So I went to become the lead actor in for Mithibai College doing theater, and then got serious about my final year BCom exams, and I quit acting. Did that for 4 years, acted in about 40 plays. And then I joined a company called Modi Xerox. And I spent a decent 10 years in office automation. And those were the years when actually, the entire financial services industry had just kind of caught up and it was booming. So, people, especially from Xerox, were in the limelight, and a lot of my colleagues, including myself, landed up with a job within financial services. And I joined Aditya Birla Capital in the year 2002. Prior to that, I was in Oman for about 5 years working for Xerox. Uh, I did exceptionally well. Now, before I come on this particular topic, so in Aditya Birla Capital, there were three roles, that I covered. So the first role was I was the head of the institution business. Now, this is probably one of the toughest businesses in the financial services area. So what our mandate was to basically go and, get hold of corporates and get them to invest their uh, employee retirement funds like gratuity and superannuation in via an insurance company. And now, why is it tough? Is because you had LIC, which was the largest behemoth and continues to remain a very strong leader in that particular space. Came with a sort of a government guarantee, right? So uh, when the treasury or the CFO is dealing with the employee funds, it's very different as compared to our own funds, right? Because this money you have, which you have to pay when the employee retires or resigns. So generally, this market, I mean, from the time we would start interacting with the customer, before even he would start thinking of, being open to the idea of handing over that money or a part of the money to you, would take anywhere between 4 to 7 years. So if you've gone to, let's say, the CFO of Bharat Bijli or a Larsen and Toubro or an Infosys, it will easily take him 4 to 7 years before he could think of, being open to the idea that, okay, you have some money, why don't you guys manage this? So a very relationship-driven business and hugely competitive. And that business, we built from hardly 350 crores of assets under management to about 10,000 crores. Then, I was also the head of direct marketing, which was again a very different business, which did very well. And then Ajay, who was the group CEO at Aditya Birla Capital in 2016, moved me to the wealth business, which wasn't really doing so well. But they obviously had a strong. Sorry, can you hear me?
We can hear you very well.
Yeah,
I
yeah.
think there was somebody
Please go
unmuted.
ahead.
Yeah. So the wealth business was actually struggling. It was a loss-making business for the Aditya Birla Group when I took over. But again, in 2 years, we moved the needle and built that business from roughly about 7,000 crores of assets under management to about 15,000 crores of assets under management and another almost 10,000 crores in advisory. So again, that business did well. Now, coming to the topic of today, what is this essentially? So how did all of this happen, right? Basically, now coming to this topic, which I think wealth is something which is very personal to all of us, right? And we're all interested in ensuring that does our money compound well? Is our money safe? Am I going to get rich? And I'm assuming, obviously, most of you guys are all rich, and would want to also understand how can I do much better than where I am, today, right? So uh, I know I have almost an hour, but this is actually a very simple topic because we've kind of made this whole area very simplistic, and I also have Aditya who's part of the team. Thanks to him, that I'm actually speaking to you guys. So so I'll just talk about my personal journey. So I've been able to compound my money at about 36% over the long term, right? Now, how did I do this? Basically, there is no magic wand. I'm extremely conservative in my approach. You can say, I'm a guy who will run far away when it comes to risk, basically, but yet I was able to do it. So I'm sure in August, gathering like yours can definitely do better than what I've been able to do. Now, the thing is, the first thing that I did, and I'm talking only out of my personal experience, is that in 2013, when I became kind of debt free, buying a house in Mumbai is a real ask, right? Basically, uh, and at that point in time when I was buying this house where I'm staying, I actually asked my question that that are you crazy? You're buying a house worth more than a crore. This was in the year 2009, right? And I couldn't sleep that night. I was just thinking, what should I do? So then I told my spouse at that point in time, chalo chodo, yeah, let's go and buy it. I told her, just get ready. She said, what? I said, let's go and book the house. So I bought this house, wondering, and with the maximum loan. I said, boss, let's take the maximum loan. I had money, right? I had another house as a like a safe deposit vault. But I said, let's do it, right? Now, that was a time when and this was in 2009, and in 4 years, I was able to pay the entire loan back, right? Now, one of the things that I have realized before we even get into asset allocation and this whole, boring area of wealth management and all of that, basically, is that the first thing you need to do is you need to invest in yourself. And what I mean by investing in yourself is that, a lot of us are worried about the fact that, okay, I have this saving. How do I invest this money well? Right? But the first thing that one should actually do is that how can I work hard to get recognized and get my paychecks or get my, if I'm a businessman, get my P&L or my cash flows to a state where it can actually make myself independent, right? So the first lesson that I learned very early on in life is that, boss, mehnat karo, work hard, which gets recognized. So automatically, if your salary or your business starts doing well, that itself is a great compounding business, right? And that's when you're actually left with, some, extra money to start basically investing. The second thing that I did was, all of us teach ourselves about how will we invest money, right? I taught myself that how will I not invest my money. So that's the first thing that I did. Okay. So there were some, if you read this book by, I think, Dr. Atul Gawande, if I'm not mistaken, called The Checklist, right? The Checklist Manifesto, something like that. It's a wonderful book. So I created a checklist about what are those 5 things that I will never do, right, in my life. At least in terms of how am I not going to invest my money. So a few things where I will never put money in a fixed deposit, right? I will never invest money in debt funds. So the second thing, I told myself is that I'll never invest in fixed income or debt funds, right? And the reason is very simple. That you on an average in India you get about 6 to 7%, and the government takes 35%, right? By way of taxes, and you're left with a paltry 4%, and that doesn't even cover the cost of inflation actually. So why should you basically do that? The third thing that I did was I've always been, and even till date, I've been an extremely disciplined saver, right? So I mean, simple thing, even so every month, whatever paychecks I would get, I would keep like maybe 1 month or 2 months of my whatever, immediate liabilities in the bank. But then I would go and invest the rest of the money, right? So even if it was 10,000, 20,000, 1 lakh, 5 lakhs, 2 lakhs, whatever was that amount, I would just go and invest that money, right? Basically. The fourth thing on my checklist was that, and it's a very difficult choice actually, is that the market comes with its own set of volatility, right? Like what we just saw over the last couple of days in terms of what's been happening, right? You have to create a very strong gut, like a real strong gut to bear that volatility, right? Like in Hindi, you can say, "Pet mein pani nahi hilna chahiye," right? And when will you be able to do this? You'll be able to do this only and only when you know that the underlying fundamentals of your portfolio are very good. The fifth thing that I did, which was the last thing, or like the other two things that I did was I read more than 200 books on investing, right? I taught myself on how to invest, right? Basically. And I structured and I created a simple philosophy around my own investing style, right? So again, you must recognize the fact that all of you are very different. So I can see a lot of names here, like, Aditya is very different, Varun would be different, Mayur would be different, Sumita would be different, Ankit would be different. We are all very different individuals, right? And our thought processes have to be aligned to the way, it will express in terms of who am I, right? So am I somebody who's conservative? Am I somebody who's a risk taker? Uh, you know, there are embedded styles within us, and you have to recognize the fact that what is it that's going to work for you, right? And once you recognize that fact, then you got to ensure that how do I just get better every day at what I do? All of us will make mistakes, right? I can give you an example that I've also gone through these mistakes tremendously, and it has actually costed me well. So, I mean, you all have heard of Bajaj Finance, right? A company called Bajaj Finance, right? I had bought more than 30,000 shares at 18 rupees. Okay. And I sold them for 21 bucks, right? Just because I actually went and listened to somebody else, right? And I said, oh, this guy probably knows better than me. Let's sell. So, one of the costliest mistakes, right? Because that stock, that 5,40,000 rupees compounded to something like 22 crores in a span of just 12, 13 years, right? Which is the biggest mistake. So clearly, that's when I realized that, one has to, build an individual moat or a competitive advantage or a learning or a style this is what is going to work for me and how do I really get better, right? So what basically I did was my learnings. I'll talk about my learnings first, and then come to this whole subject around asset allocation, and probably also drive Aditya in, and maybe show you all a small presentation in terms of our approach and what we do. Well, this is not a sales pitch, but it's just a learning. Is that I started looking at characteristics of businesses which have consistently compounded wealth for its shareholders, right? And what are those basic characteristics, right? And this is something that I picked up from my learnings across, whether you can look at Peter Lynch or Guy Spear or Monish Pabrai or Buffett or Charlie Munger or Joel Greenblatt. I mean, my library here upstairs has all those 200 books basically, and there are still maybe another 200 books that I haven't read as yet, right? But what I realized is that the biggest, moat is essentially a business's incremental return on capital, right? So any company that is able to generate a return on capital employed of 20% and is able to do that year on year is something that I'm really interested in. Right now, so when I started looking at these companies, and you'll find many such companies. So ideally, my benchmark or barometer is that at least in 8 out of the last 10 years, a company should have incrementally generated a very high return on capital, right? Now, the moment I started seeing this, what I realized is that these companies were actually driven and run by fanatics, by a set of great people, basically. So obviously, then the quality of the management becomes extremely important. So with these two vectors itself, you're able to weed out so many companies out, right? Basically. And then the third thing that I did was that do I have the capability to sit and think and understand this business, right? So, for example, I'll be very honest, I don't understand banking in India. I don't understand IT in India, right? Like that's what I said. What is it that's going to work for me? Because these are, areas where there is continuous disruption, and yeah, you don't have the ability or the math to actually try and put things in perspective and see, okay, 5, 7, 8, 9, 10 years. So you kind of avoid those businesses. Now, some of you who work for IT, would obviously understand that business much better than me, right? And the last thing that I did was I created a fabulous network of people who are very passionate about markets, who had this ability of kind of just discussing ideas, get onto those networks. You get, at least some good ideas to start working upon, and then you just start doing your homework, right? So what I realized in this journey is that most of these companies enjoyed a very strong leadership, right? Now, this leadership came from either them being enjoying a product leadership, or a market share leadership, or a profit share leadership, or a network leadership, or a cost leadership, right? So when you then start putting those things in perspective about what is so fabulous about this particular company, where it continues to grow its market share, continues to, have the ability to reinvest capital and incrementally keep earning that higher return on capital, I can tell you, you have a winner, right? Basically. And then all you need is just these 5 or 6 winners in your portfolio, right? So that is the thing that I did. And all that I did was just translated this entire learning into how a wealth business should be run in the interest of the customers, right? So what we did, and I can then share a present. I can come to that, and I can share a brief presentation that I've. So Growthfiniti was kind of started by Ankush and Ojas, who were my batchmates from Columbia Business School, and then I stepped in the year 2022 and took a kind of a majority stake, right? And now we are actually a very small boutique firm with about 16, 17 of us. Right now we manage 57 families and roughly about 320 crores. But we've been able to build these assets in about a year and a half in a very tough market environment, right? The markets have only started doing better now. But while last 3 years, obviously everybody is very gaga on the markets and the returns and stuff like that. But generally, the market and the environment has been very tough, basically. So coming to the subject on asset allocation and how do you select managers, what we've basically done and is essentially build a very strong, robust framework around this, and we've called it the efficient frontier, right? So clearly, we are a pretty much a knowledge-based wealth services firm to assist our private clients. This is me. So there are three things which are very important in terms of how do we get to that asset allocation, right? Or get to that manager selection. And how do we manage risk in the context of our portfolio, right? Now, if some of you are a part of financial markets, or if you pick up, any book which has been written by the regulators, because you got to go and certify yourself, right? Whether if you're an IA or a portfolio manager or a research analyst or even a distributor, all these books that you read as part of your pre-reading, they talk about something called as the efficient frontier, which was actually built in 1949 by a guy called Harry Markowitz. Even if you Google this on YouTube, you will be able to get to know what this efficient frontier is all about, right? Now, interestingly, in India, I'll tell you, having been on the other side of the business, I mean, I've interviewed more than 350, 400 bankers because we were building businesses, right? And, sadly enough, or, with all due respect to these guys, what I noticed that all these guys just push products in India, So even if you all have a wealth manager, you might have noticed that this guy from time to time springs up in your life and says, "Okay, boss, this fund is good, or this PMS is good, or ye AIF acha hai," right? Without actually trying to even figure out, whether it's really good for you and how is it going to impact your overall portfolio, right? Uh, so the key in the entire process is, these these are the three most important areas when it comes to you managing your own portfolio, right? So how do you allocate capital? Whom do you give your money to? And then how do you manage your risk, right? Basically. So basically, there are more than 1,730 funds, right? There are more than 100,000 global funds. I mean, India. So just imagine the opportunity in India, right? US has more than 100,000 funds, right? And India is just 1,730 funds. So even if this gets to 10,000 or 20,000, you can imagine the kind of money that can just come into this market, right? And there are more than 500 now portfolio managers in alternate assets. So how do you allocate capital, right? Basically, and then you have this whole space around unlisted startups. Every fund manager has its own unique approach. Markets and fund managers, they all go through their own cycles of outperformance and underperformance. See, you know, uh, I'll give you, and I can give you guys some very good personal examples, from my career. So, for example, everybody's heard of Rakesh Jhunjhunwala, right? And Utpal Bhai, who's the CEO at Rare Enterprises. You should go to the YouTube and look at his videos, right? Basically, he's made some wonderful presentations at the CFA Society. I was having dinner with him once, and I asked him that, what makes you guys so different, right? I mean, how did you guys become so large and so different? And you all have, and like he was able to compound his money at 60%. He's huge, right? He only said one thing, is that stomach volatility. So, for example, Rakeshji had bought, I think, maybe 1 crore shares of Titan at 6 rupees, right? And those 6 crores they become something like 16 or 18,000 crores, right? But I can tell you that stock must have fallen 50% at least 3 or 4 times, but he never sold. And that is an amazing capability and characteristic of an individual. If as long as we know what we are doing, right, and we can stomach that volatility, I can assure you, you guys will become rich, right? And this is a fact. So Growthfiniti, the tagline itself says simplicity is original. So we like to keep things very simple. The more complex you will make your life around this whole world of assets, wealth management, all of that, you will kind of just end up troubling yourself, basically. So the idea is that if you found a winner, kind of kind of hang on to it, and that winner, it has to go through this entire cycle of basically building that return on capital for you on an incremental basis. So essentially there are, this is always the paradox that we have, right? So there are return generating assets and then there are risk managing assets, basically. And from the time to time, this is what is essentially going to work. So what we've basically done is that we've looked at, uh, like I said earlier on, that I don't like fixed deposits. I don't like fixed income. I don't like real estate, right? Real estate, I think, is best to the extent that you want to live in a nice, comfortable house. That's good enough. Else, I'm a very strong, personally, I'm a very strong believer of equity as an asset class. I've learned to somehow stomach the volatility, right? And because I know that my underlying portfolio, either with managers outside or me managing, the portfolio is a very strong portfolio. So what we've basically done is that you have to look at the last 10 years of, I mean, basically variance and risk across asset classes, right? And an individual's investment performance actually is less important than how it impacts the entire portfolio. So our job, what we do very well from an asset allocation perspective, is that what we've done is we've created a budget as far as an individual client's risk is concerned. All right. And this also kind of stemmed and became more important after the Lehman Brothers crisis, right? So you had Lehman Brothers whose risk, because they were leveraged 40x, they just went bust, right? So a lot of global banks started actually looking at their own internal risk model and say, what if we were Lehman Brothers? So what they did was they created a risk budget for their own sons, right? So in simple terms, what we do very well and what I like to do for my portfolio very well is that what is the budget of risk on my portfolio, right? And that risk is essentially defined by something called as the standard deviation. So what this essentially means is that if my return expectation is say 16% and my risk budget on a portfolio is 20%, in the worst times, my portfolio can go down by at least about 25, 26%. So 40% minus 16, which is 24%. So imagine a situation is going to be very different, because I've asked this question to every investor that I've met. That if you invested your money and the markets crashed 40%, your portfolio is bound to crash 40%. Where will it start hurting you in your mind? Will it be at 10%? Will it be at 20%? Will it be at 50%? Will it be at 70%? Because you can go down 70% also, right? So imagine, you've invested, say, 1 crore, and in the first year, that 1 crore becomes 30 lakhs, right? Where will it start hurting your mind? So that's the first question that you have to ask yourself. And it's a very, very important question, right? So essentially, what happens is that every asset class, comes with, so within equities also, you have large caps, you have mid caps, you have small caps. Then there are different kinds of funds on the PMS, on the alternate side. They all come with their own risk profile, right? They all come with what is the style of the manager. I'll talk about that in a little bit of detail after this, basically. But, every manager in India, like the way I encourage you guys to think, right? Who am I? What makes me tick? Where is my core competency, right? What is it that I can understand, not understand? Those same policies or same skills lie with those managers also, right? So, for example, let's say if you've given your money to a manager and he panics, then God help you, right? Because he's going to book your loss, right? If you go to a wealth manager, I mean, I've seen situations, I've seen portfolios at the peak of COVID. There are wealth managers who sold the entire client's portfolio, giving them a drawdown of 60%. And even till date, those clients have not had the courage to go and invest the money. And the markets have gone up 3x. So if you were in the hands of a wealth manager who came to you and he said, "Ke boss, becho," and you panicked and you sold, you lost an opportunity of a lifetime. I've seen fund managers, 23rd March 2020, when the markets bottomed, there is a client whom I met, he gave 40 crores of money to a fund manager. And that fund manager did not invest a single rupee till June. And the market was already up 40%. You lost the opportunity, right? So, there are, we all talk of, I'll tell you out of my experience, people talk of asset allocation. Oh, this much in equities, this much in real estate, this much in gold. That is not asset allocation. I don't see it that way. Okay. I see it in the perspective of, who am I? What works for me? What are my goals? what is the kind of risk that I think I can take, right? And now how do I allocate capital, right? For example, when I was building the institution business, not a single customer told me. I've met the CFOs of every company. You can name it. So I knew at one point in time, we knew 2,000 companies in India. Okay. Not a single, right from Infosys to Wipro to Larsen and Toubro, you can name the company, IBM, Oracle, Stanchart, Johnson & Johnson, Levers, you can name the companies and we've met the CFOs. Not a single CFO told me that he was aggressive and he was bullish about India, right? Because these were not his money. This was his employee funds. And they were right. Everybody told us that we are very conservative. If I ask you this question, you will always start with the mind of being conservative. Okay? Because, what you think is that I'm putting my hands in your pocket and I'm trying to take your money away. Right? And that money is so dear to you, you want to just hold on to it. Right? But the moment you've given your money, you will start chasing returns. So that entire thought process of yours that you had when you started has actually gone out of the window. And now you start looking at returns. Aaj kya return aaya? Ye saal mein kya return aaya? Right? So the important thing is basically to build a certain discipline and a framework. And that framework, I think the efficient frontier, which was built actually in 1949, has stood the test of time. And it's a fabulous way of actually looking at risk, reward, and creating a portfolio, which is nothing but a combination of risk at a level of a portfolio, which is designed for you individually, right? So the key, insight of, modern portfolio theory or modern finance is actually our role should be to either optimize return for a level of risk or minimize risk for a expected return. Yeah, Sumita.
Sorry to interrupt, Bhavesh. Actually, we have some time limitations. So if we can quickly run through the major concepts, that would be very helpful.
Yeah. So, I mean, that's what I was actually just trying to say essentially is that the first concept clearly is that how do you allocate capital? Okay, I guess I've covered that bit, right? The other thing that we've basically done is so you look at so asset allocation clearly, like I said, is what is the relationship between risk and return. The next thing you have to do is please have very specific designs around your investment goals and your time horizons, basically, right? And I've spoken a lot about risk tolerance by way of actually trying to bring in the concept of what is that level of drawdowns that you think is acceptable to you when it comes to actually constructing your portfolio or your own approach to basically investing, right? And then you go down to asset allocation and how are you going to basically choose the right assets and the right managers, basically. So what we've basically done is we've built this entire framework around how do we select managers in the context of a portfolio, and there are quite a few tools available in the market which you can actually go ahead and buy and will give you a good sense of who's a good manager as far as you're concerned, right? And so I'll skip these slides. Okay, so now this is very important. See, basically, every manager in India has a certain bias, right? And these biases are actually kind of embedded in them, right? And these biases essentially come in terms of the way they actually think, on what kind of businesses or what are the kind of underlying portfolios that they will basically create, right? So quality is a factor, right? Value is a factor, momentum is a factor, and these factors would essentially work from time to time, right? So I'll give you a good example. So if you look at companies like HDFC Bank, Astral Poly, Bajaj Finance, Pidilite, Asian Paints, last 4 years, they've given you zero returns, right? So if your money was with a manager who was basically biased towards buying these kind of companies, which are high quality companies, your portfolio wouldn't have done much at all, right? So it's also important to also understand the macros and, in what scenarios will some of these factors actually work, right? And if you have a good handle around, these factors and are able to construct a portfolio, it will actually help you a lot to essentially eke out that particular excess return, right? So broadly, if I have to just summarize this discussion, I think in India, debt debt funds or the performing credits or the alternate size of the funds, the post-tax return is extremely poor. So I think they are best avoidable. Secondly, when it comes to creating an asset allocation, I think it's important to understand and create a strength area in terms of your own understanding that what is it that's going to essentially work for you. And thirdly, how do you allocate capital across some of the managers whose thought processes could be essentially aligned towards how you essentially think is something that will basically drive the performance of your savings and your incremental wealth. Now, if there are any questions, I'm happy to answer them.
And yes, of course, I cannot see any question in the chat, but if anyone has any pressing question, of course, go ahead. And thank you so much, Bhavesh. I think that was a quite informative session. And I was also again making my notes, and I was writing down some of the checklist and manifestos that you have used. Maybe it is helpful for me as well when I start the investment portfolio. I'm trying to do that. And also how to select a manager, that's very important. And the example that you gave was literally, something very apt, because I had faced a similar issue when my husband sold some of the shares, and I kept on insisting, don't sell, don't sell, you're not taking a wrong decision, and now he repents. So very valuable insights. Thank you.
Hey, hi, Bhavesh, Sanjay here. What is your limit of accepting that the risk, how much risk you can afford in your portfolio? What should be is there any guidance or anything? 40%, 50%, 70%?
Yeah, so okay, so I can take my personal example. I can go down 50%.
And after that, is there any chance happened that you really went to 50%, or it has turned around to like plus 50%?
I've gone down 50%. There are days when I've seen my portfolio drop 30, 40 lakhs. But, like I said, my entire style has been around how I've created these leadership portfolios, right? So I'm okay because I know that the strength of my underlying portfolio and the companies that I have are very strong. So they will bounce back. So I'm actually, sometimes I'm happy that they go down because I can buy more of those.
Hi Bhavesh, good evening. This is
Good evening.
Subhanshu.
Yes, sir.
Just my question is, I have already have done the mistake. Now I am 45. Until 44 years of age, I was saving my salary in the fixed deposit. So now only 1 year before my friend suggested, now I have started investing. So I have given to a broker and he is investing in mutual funds. So is it the correct way, or should I start invest in equities? Only
so the underlying portfolio of a mutual fund is equities, right? I mean, depends upon what he's bought, right? So the benefit that you get because you're starting now, I think if you ask me, a mutual fund or a managed portfolio route is a better option, right? But the important thing is how's the entire capital allocation happening. So if you guys can, when you get the time, I mean, I can just, again, this is not a marketing pitch, but this entire story, okay, I have kind of brought it on my website. So if you guys go to growthfiniti.com, I've written everything. So what is a leadership portfolio all about, right? Stuff like that. Then from time to time, we put up some wonderful presentations, all free of cost, available to everyone to see. So there is a tab called Money Trends. You'll be able to see every month. You can just go and see this. There's a nice presentation that we put up. I keep writing blogs from time to time whenever I have time. So I've written on factors. I've written the power of behavioral investing. I've written on building a money mindset. And, I just hope that you guys won't find this boring, but, it takes me almost a day to write one particular vlog, at least 2-3 hours in terms of just trying to bring my thought process in. But, you guys can, always, happy to share this so that you all can go through it. Basically.
Okay, Bhavesh, last question is the broker to whom I'm giving the money for investment. He's a only single person. There is no firm or any subordinates, or there is no team, and he's also not a professional chartered accountant or any qualified person. But from his experience, he's doing since maybe 30 years. So is it the correct way? Should I give to that person, or I should give to a farm, investment firm? Which is a better thing?
See, I can always tell you that you can, talk to Aditya, who heads asset allocation, and come to us.
Correct.
Okay.
See, I think it's a matter of a personal choice. The fact that you've gone to him is because you trust him, right? See, most people who come to us is because of two things. One is either the knowledge or the experience, or they don't have the time and the wherewithal to do it. I can only tell you out of my experience, if you don't have the time to read the annual report of a company, go through the transcript of the management and the quarterly con calls, build a valuation model on your own, understand the business on your own, and have the ability to think what this business can do, please don't buy equities directly. If this guy is doing all of this for you, then you shouldn't have a problem. Again, you will always, see, everybody's human and they're bound to make mistakes, right? But the lesser the mistakes in the portfolio, the better you're compounding. It's as simple as that. Yeah.
Can you share the Aditya's number in the chat or something? That we will
Aditya can put it. Aditya, tera number dal dena. Aditya is here. He's here.
Okay. Yeah.
We'll put our email ID also in case you want it. Aditya can put his email ID also. That also works basically.
Okay. Thank you. Bhavesh.
So is there any other? There are some questions. Somebody asked me about if your fund manager is driven, in that case, resignation has a huge impact which will lead to redeeming.
Like Bhavesh, Varun had asked a question in terms of small cap managers. So typically, Varun, what would happen is if the manager is very skilled and if the alpha is driven by his high conviction bets, in that case, you would redeem that manager if he's going to resign from that fund. But if that fund is driven by a process, let's say the fund house is a great process in place wherein the team is strong, there is a co-manager, and the process is very well defined. In that case, you would typically wait for the new manager to come in. You would assess that new manager, does he have that skill? Does he have the track record? So if that is intact, then you would continue holding on to the fund, but you would keep a continuous vigil on the new fund manager. And if there are issues, then you would exit. Otherwise, you would continue holding on to the fund manager. So it depends from case to case. So it's not necessarily a generic way to answer it.
So I can just add to this, Varun, before you have another question. So, for example, recently, I won't name the fund house, but recently there is a fund manager with almost 15 years of track record of managing that fund. An outstanding job he's done. Under his capable hands, the fund has gone to now from hardly 500 crores to 40,000 crores. Now that fund manager is quit. Now the fund house has given that fund to a new manager who unfortunately has had a very poor track record. Right. Now we obviously have access to all these guys. So, we've had, a couple of round of meetings to understand his style, what is he going to do. And we've already put that fund in our radar. So while we have a substantial exposure of our clients' money in that fund, we have chosen not to incrementally add till we see the consistency of that particular fund manager also replicating what the previous guy did. Now we will do this for about a year, right? If it doesn't come back in a year or so, we are not looking at top quartile performance, but we are looking at consistency and certainly not a bottom quartile performance. So if the entire category that guy is either in the top or the second quartile, we are happy. But if he's going to drop to third and fourth quartile, then we are going to be worried.
Yeah. No, it's like for a person who is monitoring this on a regular basis, like y'all, it's easy. But what about us? On the retail level, we hardly have time to monitor a fund manager. We don't even know. The other day,
that's why people come to us, Varun.
Yeah, that day I came to know somebody. I was invested in Access, mid cap or small cap, and someone was front running that scheme, and I came to know 1 year after they were front running it. So,
so I won't comment. See, okay, so Shreyas is a terrific guy. Okay, Shreyas is the head of equities at Access. I think he's a fantastic guy. We hold that fund house in pretty high regards. I don't see there is any cause of any worry. I don't think it will be fair to comment on the subject that you spoke about, especially, given the fact that, I can tell you there is nothing to worry as far as the underlying portfolio is concerned. Now that fund, may go through its own ups and downs, given the cycle that it is in, given the fact that it has a quality bias, and quality as a factor hasn't done well for the last 4 years. But I don't think there is any cause of worry.
Oh yeah,
that is our analysis.
Yeah, and as we're on this subject, Bhavesh and Aditya, if you can at least tell us like a little bit on how y'all contribute. Like in cases of we investing in funds directly at the retail level, but actually coming to y'all and then y'all taking that decision to invest for us. How is this different from us doing it? Because this is the perfect example, right, to talk about that.
Yeah, so essentially, see, we are basically an AMFI registered distributor, right? However, we, at least in our philosophy, we are product agnostic, right? And we are agnostic to the fact that, ultimately we earn our trail commissions from the manufacturer because we give them business, right? So in a way, we are distributors, but we are basically aligned to, our customers' interest, basically, right? So what we do is, first is how do you get the analysis around capital allocation, right? So what is it that we believe or you believe will work for you? So what's our ideal structure of the portfolio? And then we get, the underlying funds or the underlying fund managers, depending on the size, depending on the portfolio, and create and curate a portfolio for you, basically, right? And then we keep a track on the performance. We do that every month, right? And we review client portfolios once a quarter or once a 6 months, depending on the client availability and the size of the portfolio, right? Or sometimes it could be once a year.
Yeah, like to add on to that. So basically, Varun, there are basically 5 factors in the market which Bhavesh important to understand how do you allocate between those 5 factors. So it's not necessary that each factor will work. So for the last 3 years, value as a factor did phenomenally well, but quality didn't do well, right? So if you allocate in the right way, these factors have created alpha over the long run. Like if you look at it over the last 5 or 10 years, these factors like low volatility, quality, momentum, growth, all of these factors have done phenomenally well. So if you allocate in the right way, what will happen is you will be able to generate alpha from a specific factor in a given year. So last 3 years value did well, but if you would have been going into a quality managers, you wouldn't have done well. So if you allocate to but in the short run, you will get the alpha as well. So you allocate it in the right way so that you get that alpha over the long run. And you ensure that the volatility is also maintained. So I think a lot of clients, what they realize is volatility is a very important factor in terms of the portfolio's performance. So if you over allocate to say small caps, I mean, we see that in a lot of clients today, like them allocating 40%, 50% to small caps, whereas we are only at 12% in our small cap allocation. The reason for that asset class, it goes up, that's going to hurt your returns in the long run, right? So if you're compounding your wealth, you don't want the volatility to affect your returns. And a common example is like if you went down 50% first year, it would take you 100% to get back to the original capital. So that is the crux in terms of how do you construct a portfolio wherein you're compounding your wealth while maintaining that volatility. And that's where the efficient frontier plays a...
Thank you so much, Bhavesh and Aditya, to give us so much of insight. I think that was very useful, and the questions will be never ending because it's about money and wealth. So, and you have been kind enough to give us your numbers. So, of course, anybody who wants to reach out to you can reach out. And so, Nikita, thank you so much for the insightful session. And I do have some questions, and I might come back to you, and we can have a good discussion separately. So, thank you everyone for joining in. And I think these Friday evenings are real fun, and that gives me a boost for the weekend. So thank you everyone. Have a wonderful weekend and enjoy yourself. Bye. Good night.
Thank you. Thank you so much, guys. Yeah.
Have a great weekend, guys. See you.
Thanks, Jay and team. Thanks, Alicia.